Hello, very good morning to all and happy Friday. Welcome to today's Daily Dose of Market Insights. I'm Kelvin here again. Very good morning. Today will be Friday, the 24th of May 2024. So before we jump straight into our short-term Daily Dose of Market Insights for today, let's have a quick look at the disclaimer first. All right. Leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. Okay, so now let's have a quick recap of what has taken shape yesterday and as well as early today's Asia session in terms of the broad-based asset class movement and as well as their respective key events and economic data releases. So let us start with the US session yesterday. So over at the US session yesterday, we do know that the markets actually rose at the start of the US session due to the expected, we call it risk-on behavior being triggered by that very rosy NVIDIA earnings release that has taken shape in yesterday's early Asia session after the close of a Wednesday US session. So the market rallied, which causes the both the S&P 500 and the Nasdaq 100 to hit a fresh all-time intraday high. But thereafter, the market actually tumbled. If you look at since this the split up on the S&P 500 to fresh intraday all-time high, and thereafter it actually tumbled all the way down to close near its lows. Very similar to, and it recorded a loss of negative 0.7%. Very similar to the Nasdaq 100 as well, but at a smaller magnitude loss of negative 0.44% due to the positive gain of 9% from the NVIDIA. Dow Jones Industrial Average, which is the worst performing, negative 1.53% because of the lack of technology stocks inside the component. Not say lack of technology, lesser reliance of technology stock inside is 30 within this 30 component stocks that actually explain its underperformance of negative 1.5%, and the Russell came in also very similar at 1.6%. And if you look at the heat map of the S&P 500, very clearly the one that is only holding the fort in the entire almost sea of red is NVIDIA, a gain of 9.3%. So what we could see over here is that we realize that how important NVIDIA is towards these two major indices. So now the key story over here is that yes, despite the fact that NVIDIA is a very key component stock inside the S&P 500 and the Nasdaq 100, what causes the bloodbath in the S&P 500, or I would say that the Nasdaq 100 and as well as the entire US stock market yesterday was very likely due to the revival of adverse macro factors. So at the start of this week and even late last week, I do mention that the US stock market is been more and more, it tends to be dosed in the optimism of micro factors, that's earnings growth and as well as momentum play. And macro factor is taking a backseat. That means, i.e., the movement of that US Treasury yield that has recovered, exposed last Wednesday CPI data release, and with that dollar strength coming back into the picture. The market has been ignoring this since the start of this week until yesterday, when there is a particular key economic data that trigger this further push up in the US 10-year Treasury yield, which eventually starts to see a pickup in US dollar strength, and thereafter this adverse macro effect start to spill over into that US stock market yesterday that causes the weak intraday movement throughout the later part of the second session of the US session. So what is this key economic data that triggered this push in the US 10-year Treasury yield? It will be that ISM flash PMI data that rose to 1-year high, the services PMI. So yesterday we know that we received a slew of CPI data, yes, not CPI data, ISM, pardon me, ISM PMI flash data across the world. That means we have in Japan, in Australia, in Eurozone, in UK and US. So yesterday, US at 9:45 p.m. it releases the the S&P flash data, but it's only after the second half of the US session, all right, at around 12:30 a.m. Singapore time, where we see the steep sell-off take shape. All right, so it's all very dependent on the movement of that 10-year treasury yield that causes it. It's not the release of the data. So sometimes you see the news report, they say, hey, data released all this, but the release of the data was 9:45 p.m., somewhere around here. But at that point in time, the S&P didn't actually sell off that much. Yeah, it came down a fair bit after it's split up at the open due to NVIDIA earnings results the previous day after the close of the US session at Wednesday. Then 15 minutes later, the market came down, but it's just not that bad. The sell-off didn't actually sell off that much after the release of that news. But what's interesting is only how the market react thereafter in the dollar strength and the US 10-year treasury yield at this point in time at 12:30 a.m. Singapore time. So what we could see over here is that, let me go back to the data over here again. Okay, so this services PMI data, which is very important compared to the US manufacturing. Why? Because we know that services constitute to almost two-thirds of US economic growth, okay, over manufacturing. So if you look at the services PMI flash, it actually came above expectation of 51.3 and also above expectation of the previous April reading of 51.3 as well. So it came in at 54.8, and you look at the trend, it's the steepest pace of increase in almost 1 year. Okay, there's this jump up over here, and if you look at the 5-year trend, very clearly is in a state of rebounding. 54.8, so it's almost May last year at 54.9, so it's almost rose or expand to a 1-year high. So what does it mean for the US Federal Reserve monetary policy? So that for sure, if you see a rise in the US services PMI, that means i.e. implying to us that the US services activity is robust, there is actually lesser reason for the US Federal Reserve to ignite interest rate cut aggressively this year. And with that, that actually reduces the odds of the number of interest rate cuts in 2024 as being priced in by the Fed Funds futures market, compiled by the CME Fed Watch tool that I will always show in my daily dose of market insights to have a gauge what the market expectation is in terms of the swinging of the pendulum expectation of interest rate cut or hike going forward in the US. So you look at the CME Fed Watch tool right now, for sure there will be 100% no cut coming in the June meeting. Okay, because currently right now the market is at the current Fed fund rate is at 5.25% to 5.5%. So almost 100% or 99% indication that there will be no interest rate cut as implied by the CME Fed Watch tool based on the pricing of the Fed funds interest rate futures. And if you look at the 1 September meeting, where in the last 2 or 3 weeks, the market has started to price in a high odds in the September meeting. Right now, the odds has already reduced by almost 50%. All right, so if you look at the current situation right now, this is the current rate of 5.25% to 5.5%. So previously, about 1 week ago, is pricing at 50%. Now it's slightly dipped to 46%. And if you look at accumulation of 46 plus 6%, because there's a 6% odds that there is a 50 basis point cut to 4.75 to 5%. So you add these two together, cumulatively, it's about 52%. And that December meeting, initially, there's a chance of another 50% cut to bring down to 4.5% to to bring down to 4.7% to 5%. That means after the September 25 basis point cut, this one has greatly been reduced to 33%. So to have a better snapshot, right? I mean, if you don't want to do the calculation of the individual, we call it probability, immediately we can go on to this probability tab and look up for the aggregated meeting probability instead. So this will give us a clearer picture. All right, so I expand my screen over here. So what we could see over here is that still in mind the current Fed fund rates is at 5.5%. So at the top here is the Fed funds rates. Okay, currently is 5.5%. If you move back to your left, it shows that the Fed funds rate is getting reduced by 25 basis point each. And down this column here is the meeting dates of the next FOMC meeting in month, date, year order. All right. So we could look at over here in the month of September, there is cumulative probability of 59.19% that the Fed funds rate will reduce down to 5.5% to 5.25%. That means that's implied a 25 basis point cut of a higher of a probability of more than 50%. And if you look down the line over here, it remains the same for November meeting, and right now 60% chance will also remain the same in the December meeting. So previously the December meeting, there's actually a slight chance, about slightly 50% odds that it will do another cut of 25 basis point to bring it down to 4.75% to 5.5% the Fed funds rate. But in the December meeting right now, based on the CME Fed Watch 2 pricing, it only shows a chance of 40%. That means less than 50%. So based on yesterday's data, very rosy data release of the ISM services PMI, it actually switched the pendulum slightly right now to only price in only one interest rate cut in 2024 from prior to the ISM release data yesterday. That means in Wednesday, it's still showing two interest rate cuts. So that actually causes the US 10-year Treasury yield to actually spike up. Okay, yesterday. Okay, so if you look at the hourly chart, okay, so if you look at this hourly chart over here, it spiked up at around 10 a.m. 10 p.m. Singapore time. All right, 10 p.m. Singapore time, it spiked up and hit the 20-day moving average at around 4.5%. That is acting as a clear resistance, all right, level. Then before trading down slightly on the hourly chart. But nevertheless, if you look at the strong push up on a daily basis on the 10-year US Treasury yield, it has totally erased off last Wednesday exposed CPI data sell off. Okay, so right now it's touching the very clear key level of 4.5% again. So if it starts to rise above 4.5%, have a daily close above 4.5%, that means what it means, i.e. the trajectory of this medium term uptrend since the low of December last year remains intact. That means if the medium-term uptrend remains intact for the 10-year Treasury yield, that means there is a high chance of it to trace higher high. That means surpassing the high of April this year at 4.8%. Okay, so what it means that going down the line, if the pricing of the CME Fed Watch 2 starts to only show one interest rate cut going forward in the next couple of weeks. Then also don't forget over here is that next month we do have the Federal Reserve Fed Fund minutes, Fed Fund meeting. We'll talk about that much more later as we approach that date earlier in June, which is 12th of June. That'll be the next Fed Funds FOMC meeting. And in the June meeting, they also release their latest dot plot. Okay, so this latest dot plot will show the median projection of Federal Reserve officials' view on the Fed funds rate going forward this year and next year. And based on the last dot plot that was released in March, the US Federal Reserve official still has an implied projection of 3 interest rate cut in 2024. So that should be greatly reduced to at least 1 for this year, or could be potentially it might start to pin down to 0 interest rate cut. All right, if we start to say 0 interest rate cut, that could also definitely see a further rise in the US 10-year Treasury yield going forward. But we are taking things one step at a time. But if it starts to do where is it? Yeah, over here, it starts to break above 4.5%, then we will to be very cautious again on the movement in the risk asset classes, especially the US stock market indices going forward. Because why? Because macro factor could actually come back to play a picture to detect the movement of the major US stock indices, given the fact that Nvidia earnings is already over. Okay, it's already over, and we got to look at back then the next earnings seasons will be only come in somewhere around a month later. So that could take a driver's seat again in terms of the macro factor. And with the 10-year US Treasury push up higher, we start to see the dollar strength coming back as well. Okay, but look at the dollar index over here. Okay, so if you look at the dollar index, it's also testing the 20-day moving average as well. Okay, at around this 105.20 level. All right, this dollar index over here. So at this point in time, notice that the movement of the dollar index also rise in conjunction with the 10-year US Treasury bill after testing the 200-day moving average and the key medium-term pivotal support of 104.20. Okay, so with the rise of the dollar strength coming back into the picture, that also could be a negative macro factor that could impact the major stock indices, okay, going forward. So with that, also something to keep in mind as well. And right now, if you look at the current movement of that US 10-year the broad-based US dollar strength from a 5-day rolling performance basis as of now, as we're talking. Okay, as we're talking over here. So what we could see over here is that very clearly the dollar is strengthening against the Aussie dollar, which yesterday we did share in our short-term technical outlook. We still maintain that short-term bearish bias because it hit very close to the upper limit of a medium-term symmetrical triangle range configuration that has taken shape at the start of this week. Not to worry, if you sound this too foreign to you, I'll flash again the short-term technical outlook of that Aussie dollar chart while after we do that short-term technical, intraday analysis on the FX market. But I want to stress you all is why do you see the Aussie dollar is weakening the most against the dollar? That means this dollar against Aussie, or why the dollar is strengthening the most against the Aussie on a 5-day basis, 5-day rolling performance basis, because the Australia dollar is being used as a risk-off, risk-on currency proxy. That means we start to see risk-off in the risk asset. That means using the stock indices as a benchmark, we tend to see weakness in the Aussie dollar. So that actually explains the strong movement of the dollar against the Aussie right now, being the top performing based, i.e. the dollar is the strongest against the Aussie, against other major pair. And what we could see over here is that follow up the CAD and the dollar yen is also catching up as well. Okay, it's also catching up and also move against the dollar index movement. All right, so it's also surpassed the 5-day rolling performance of the dollar index. So anything that means, i.e. the dollar is also showing signs of strengthening against the yen. Why? Because this morning, before the start of the daily dose, we see a release of this key Japan inflation data. So what I want to highlight over here is do take a look at the core rate data, the core rate, not the core, because Japan there's two rate. There is one called core inflation and core inflation. So core inflation exclude both food and energy, which is this particular inflation matrix is closely monitored by the Bank of Japan, whether the Japanese economy is in a state of a very sustainable inflationary trend holding above their 2% target. So if you look at the core inflation rate in Japan for the month of April, it slowly starts to actually its path of deceleration continues since November last year. So previously it was at 2.9% year on year in March, and right now it slipped down to 2.4% year on year and below expectation or forecast of around 2.5, 2.6%. So if you look at the trend, okay, it's continue its path of deceleration. All right, but it's still hovering above the 2% level. Okay, but it seems to me it's coming very dangerously close to the 2% level. It's not picking up. There's no signs of turning around. So that actually explains a negative feedback loop from the very rather weak core or softening core CPI data in Japan for April. Negative feedback loop that is spilling over to the Japanese yen that causes the dollar strength to strengthen against it as well. All right, so that is the key. Then also don't forget, with that strong dollar strength coming into play, it starts to see also weakness in gold, and as well as other commodities like the West Texas crude oil to actually inch down lower yesterday as well. Right, so that is the key fundamental news, and as well as the intermarket correlation. The main catalyst is that rise in that US 10-year Treasury yield pretty steeply yesterday, triggering off a continuation move in the dollar strength as well. And also yesterday we do have one of the ECB officials speaking as well as they saying that ECB is still on course for a June rate cut. So that add on further fuel for the dollar strength to strengthen yesterday against the Eurozone and against the Euro dollar. All right, so now with that, let us now very quickly jump straight into the short-term technical outlook. Let us start with the FX market first over here. So with that, let us start with the euro dollar. So the euro dollar, okay, now before we start, let me expand my screen so that you guys could see. So the euro dollar actually nicely, that earlier spurt up, that bounce before the start of the US session at around 8 p.m. Singapore time, actually did a bearish reaction of this former minor ascending channel support, then pullback resistance over here, and it came down. So with that, it almost hit the first support level that we highlighted yesterday at 1.08, and I will use this inflection point yesterday as my Titan key short-term pivotal support for today at 1.086 to maintain that short-term bearish bias on the euro dollar. A break below 1.08 exposed the next near-term support level at 1.077, and below it sees 1.0730 next, which is the minor swing low area of 9th of May. All right, and as well as if you do the Fibo retracement of that prior push up, okay, that confluence with roughly the golden ratio of 61.8%. Give me a minute. Okay, 61.8%. Okay, slightly above it. Okay, the 61.8% is at 0.0714. Okay, slightly above it. Only an hourly close above 1.0860 will invalidate today's intraday bearish bias on the euro dollar to see another round of rebound taking shape to retest 1.09. Above 1.09 exposes 1.0925/0940. So even the pretty resilient sterling dollar has started to break down as well below yesterday's trigger level at 1.27. Okay, it break down below this 1.27 level. Okay, during the end of the US session, towards the end of the US session. All right, over here. Okay, at 2 a.m. Singapore time, means coming towards the end of the US session. So I don't want to use 1.27 as my short-term pivotal support resistance, the short-term pivotal resistance level to maintain today's intraday bearish bias view on the sterling dollar. I will still maintain that 1.2740/1.2760 as my short-term pivotal resistance level. First support level to watch out for will be at 1.2640/1.2610. A break below it exposes 1.2565, which is close to the 200-day moving average, as well as the lower boundary of this minor ascending channel that I drew from the low of 22nd of April. Only an hourly close above 1.2760 will invalidate this short-term bearish bias on sterling dollar to see another round of rebound taking shape to expose the next near-term resistance coming in at 1.28 figure, followed by 1.2860. Asia Pacific currency, let's start with the Aussie dollar first. So for the Aussie dollar, price action continuing to tumble and almost coming down very close to the first short-term support that we highlighted yesterday, and also now break below that 20-day moving average as expressed on the hourly time frame chart. All right, so with that, the RSI is still showing no signs of a bullish divergence. There's no bullish divergence clearly, right? So meaning that short-term downside momentum still remains intact, but right now it's coming to that oversold region again and coming very close to the first short-term support at 65.85. So as usual, there could be a chance of a minor bounce first before another potential bearish momentum takes hold in the short term. So potential bounce could be this level here at 66.27, 66.27 level. All right, this, pardon me, not, it should be this level, okay, this level here, okay, before the start of that bearish hourly candle that takes shape at 1 a.m. Singapore time yesterday, after breaking down below this minor congestion area lows in the European during the European session. All right, so this bounce, I mean, given that it's oversold and it's coming very close to the first support of 65.85, potentially there could be a bounce taking shape first before another round of bearish momentum coming into play. So, but I do not want to use 66.18 as my tighten short-term pivotal resistance. It's too tight. I will use that yesterday's clear inflection level, which is that inverted V, after it tests this minor range support level, then where that bearish reaction takes shape, the inverted V. So using 66.50, so as long as any bounce didn't surpass this tighten 66.50 short-term pivotal resistance, we will still maintain that short-term bearish bias on the Aussie dollar. A break below 65.80 thereafter exposes the next support area or next support level at 65.20, which also correspond to the 200-day moving average. So bear in mind, if we start to see an hourly close above 66.50, it will negate the short-term bearish bias to see another rebound up to 66.80, followed by the key medium-term pivotal resistance at 67.50. So why 67.50 is important? Because 67.50 is in fact the upper boundary of this, okay, 67.30, 67.50. Yeah. Okay, so I've got to put it over here. Okay, so it's 67.30/50. Okay, so why is it important? Because this level here, okay, is the upper limit of this ongoing daily symmetrical ongoing medium-term symmetrical triangle, all right, that is in place since the low of 13th of October last year. If you look at this gray line, this gray line, this descending trend line, this ascending trend line is a symmetrical triangle since 13th of October last year, as expressed on the daily chart of the Aussie dollar. So net, the Aussie dollar, there is clearly no clear trend yet that's being formed on a medium-term time horizon, that means as seen on the daily time frame. But on a very, very short-term horizon, that means on the hourly time frame, there could be still downside pressure within this symmetrical triangle range, because it really come very close to the upper limit of the symmetrical triangle. And going forward, the next step it could go, if it breaks below that 200-day moving area, it could expose the lower limit of that symmetrical triangle. But will it go there within one single day? I cannot tell you I can tell you 100% for sure. So we are taking things one step at a time by doing that short-term technical analysis on the hourly time frame. All right, so that's why I shared with you all those rather key shorter-term levels to watch out for, technical levels to watch out for. Okay, that's for that for the Aussie dollar. Now the dollar yen. So like I said earlier on, due to the fact of that deceleration in the Japan core CPI for the month of April, that actually support dollar strength coming back to the picture, and now it's actually piercing above the 157 level. Okay, now it's trading at 157.08. Still recall that yesterday we do have a neutrality stance, neutrality stance, and given that the price action has clearly inching upwards, no clear signs of a bearish divergence on the hourly RSI, and the RSI going to be held above this parallel key ascending trend line support level. That's, I think, a support at around the 50 level mark as well. So with that, I will flip to a bullish bias for today, short term on the dollar yen. First support level to watch will be at 156.60 level, 156.50 level, which is the break of this above this minor former 14th of May swing high. Yesterday it broke out, tested, and shaped that huge bounce off during the US session yesterday, and now it's trying to inch up higher above the 156.60 level. I will use slightly lower at 155.90, which is also correspond to the 20-day moving average. So as long as any potential pullback didn't surpass 155.90, flip to a short-term bullish bias on the dollar yen. Next resistance level to watch, 158 figure level, which is the former minus the swing high of 1st of May that kickstarted that potential alleged second round of BOJ intervention as instructed by the MOF to sell dollar and buy yen. Above 158 exposes the long-term pivotal resistance zone of 159.60 and 160.30 level, right exactly at the close to the high of 29th of April, where potentially that alleged first BOJ intervention takes shape earlier on around 4 weeks ago, right? That's for the only an hourly close below 155.90 will invalidate these short-term bullish buyers to see another round of decline within this within this sideways rangy configuration to expose 154.30. Below it sees 153.70, which correspond to the rising 50-day moving average acting as a support level as well. Okay, so that's pretty much sum up for the FX story. So what you could see, the FX story is the dollar remains on a kind of a short-term support level in the respective major dollar pair. Okay, so that's for the FX story. Now let us go to the major stock indices, which is getting very, very complicating right now due to the revival of adverse macro factor. Okay, so now what we could see is, let's start with the Hong Kong 33 first. So the Hong Kong 33 yesterday, we do have a short-term pivotal resistance support level to watch, not resistance, pivotal support level to watch at 184.60. Price action came down during the overnight US session, and in today Asia session it opened weaker and now trying to test that 20-day moving average, all right, which is slightly above the 184.60 short-term pivotal support level. And this short-term pivotal support level also confluence with a Fibo retracement level, okay, which is close to the 38.2% Fibo retracement, right, very close to it. And what's interesting over here, that RSI now has started to shape that bullish divergence, all right, and now trying to actually inch to print a higher low as well after that bullish divergence has taken shape. Okay, now back to the price section of the chart. Okay, so for sure what we got to do over here is this. Yes, we will still maintain that short-term bullish bias, but I need to have a potential upside trigger level to increase the odds of a recovery, okay, which is at 19,210 level. So this 19,210 level is in fact Tuesday minor congestion area breakdown turns into a pullback resistance. All right, so only an hourly close above 19,210 will only increase the odds of a recovery. Then thereafter we may see the next resistance coming in at this 19,790/19,980. An hourly close below 18,460 will see the continuation of this corrective decline to take shape, to extend, to expose the next support area at 18,240, 17,890/17,560, which correspond to the 50-day moving average and closely to the 61.8% Fibo retracement as well of the previous up move from 19th of April to 17th of March. Okay, so that's the key level to watch on the Hong Kong 33. Still maintain that short-term bearish bias technical outlook, but we do have a 19,210 potential upside trigger level to watch that the price action got to surpass above it to increase the odds of the recovery, all right, in Hong Kong 33. The Japan 225, another round, it came down again, very messy movement and bounced off right at the 20-day moving average and the pivotal support that we highlighted yesterday at 38,460. And also the RSI also starts to shape that bullish divergence as well by printing higher low. Okay, whilst price action is showing almost similar lower, all right, over here. So nevertheless, we also have that upside trigger level at 38,975. So this is something like a failure breakout above the 50-day moving average before. Then thereafter, we start to see the sharp intraday sell-off during the European session yesterday and throughout the US session. So for sure, this is a very important level in order for the boost to gain a better foothold on the Japan 225. So still maintain that short-term bullish bias, 38,460, because it bounced off here and given the fact that the way it bounced off, it also lead to a bullish divergence on the hourly RSI. But we added on a potential upside trigger level at 38,975. That means price action got to surpass above 38,975 to increase the odds of a potential recovery to retest this week high area at 39,500 next. However, an hourly close below 38,460 will invalidate this bullish bias scenario to see the continuation of another round of very messy corrective decline scenario within this complex range configuration that is unfolding in the Japan 225. Next support level to watch will be at 38,015, 37,750 level, which is the minor swing low of 9th of May and 2nd of May, and also corresponding to this very key major trend line support level in gray, okay, that I drew from the low of 4th of October. Okay, that's acting as a support at 37,750 as well. Okay, so this is the key levels to watch on the Japan 225. Yeah, we'll still maintain that short-term bullish bias, but with a lower conviction, unless 38,975 is taken up, all right, on the upside. Now, German 30. So German 30 continues to actually trade lower by shaping a series of lower high and lower low. And yesterday, lower low over here, okay, lower low, it saw a bullish divergence that has been taken shape again. Okay, bullish divergence. And also, if we could extend it, there's actually this line here. So what we could see is that this positive element, right, indicating to us that yesterday's push down, right, might be a push down that comes with slower momentum, and it's rather a corrective move rather than a start of a medium-term downtrending move, right? Because of this bullish divergence. And also, if you look at the current low that is formed, it came close to the 38% Fibo retracement as well. Over here, 38% Fibo retracement. Okay, let me, because you can't see, right? Let me, where the hell is it? Center, okay? 30% Fibo retracement. Okay, so with that, and the 30% Fibo retracement also came slightly above the rising 20-day moving average. So with that, right, I'll be using this 20-day moving average as my short-term pivotal support for today, 18,460 level. Okay, and in order to see a much more substantial recovery, for sure, it got to break above yesterday's minor swing high at 18,730. Okay, let me put it down so that you guys could see it clearer. Okay, 18,730, we saw confluence with this minor descending trend line that is in place since its all-time high of 16th of May. So unless we see an hourly close above this level, then we could have a much more reinforced or increase the odds of a potential recovery to at least see the next resistance coming at the close to the all-time high area at 18,920. However, an hourly close below 18,470 will invalidate this short-term potential recovery bias to see the minor corrective decline extend towards 18,320, which is the 50-day moving average, I think, as a support level as well, and as well as this minor swing high area of 24th of April. If we start to go below 18,320, then this medium-term uptrend will be in jeopardy to expose the next support level in first step at 18,160. Okay, that's for the German 30 short-term technical outlook, key levels to watch. Now, very interestingly, this is the Nasdaq 100. Okay, so the Nasdaq 100, yes, we see a sell-off that took shape yesterday. But after a sell-off, where it managed to hold, it hold exactly at the tightened short-term pivotal support that we highlighted yesterday at 18,580. So this level of support still holds at 18,580, and also the lower boundary of this steepened minor ascending channel that I drew from the low of 1st of May. Okay, so given that the support level it still holds, we will still maintain that short-term bullish bias on the US Nasdaq 100, but with a lower conviction now due to that adverse macro factor in the background, which is the rising 10-year US Treasury yield, leading to a stronger dollar. I will add a potential upside trigger level for today's intraday short-term technical outlook, which is 18,740. So only an hourly close or breakout above 18,740 will increase the odds of this potential short-term bullish bias on the US Nasdaq 100 for the next resistance to come in at 18,990/19,055. However, an hourly close below 18,580 will invalidate this short-term bullish bias and will kickstart a steeper minor corrective decline towards the 20-day and the 50-day moving average that is acting as a support at 18,230, 18,100 level. Okay. Dow Jones. Okay, so Dow Jones yesterday, or the US Wall Street 30 broke below our short-term pivotal support level that we highlighted yesterday at around 39,600 level. And elements are rather mixed right now. It also break below the 20-day moving average, but still managed to hold above the 50-day moving average. That is acting as a support at 38,970 as well. All right, confirming that level. And if we do the Fibo retracement of this last push up from 1st of May all the way up to the all-time high on this Monday area, it's correspond to the 50% Fibo retracement, very closely, the 50% Fibo retracement. So with that, due to mixed element, I will have a neutrality stance for the US Wall Street today, neutral between 39,390 and 38,970. It's only, however, if we start to see an hourly close below 38,970, then this medium-term outlook or medium-term uptrend on the US Wall Street 30 will be in jeopardy. Why? Because there's a break below the 50-day moving average to expose the next support area at 38,500/38,330, which is the 61.8 Fibo retracement and the 76% Fibo retracement, and as well confluencing with this clear major trend line, ascending trend line in gray that I drew from the low of 27th of October last year. Okay, that is confluencing at the 38,550/38,330 next near-term support zone if 38,970 doesn't hold for today. Okay, so that's for the short-term technical outlook for the major stock indices. Yes, majority, all of them are still holding to some form of their respective key support area in short term, but technical elements is not so skewed towards the bullish side of the story, where I added in various respective level of potential upside trigger level, where this level got to surpass to actually increase the odds of a recovery scenario in the short term for today. Okay, on the major stock indices. Okay, now commodities, let's go to spot gold first. So spot gold yesterday we flipped to a short-term bearish bias. Okay, so price action already almost hit that level, the first support level at around this 32,340 level mark. All right, over here. And what we could see right now is coming very close to the 50-day moving average that is acting as a support at 2307 level, 2307 level, and the RSI is also at the oversold region as well. No bullish divergence yet. So with that, what I could do over here is that I will use 2,307 as my short-term pivotal support level to watch for today. But price action got to break up above 2,355. So this is something like an upside trigger level in order to see a recovery, a potential recovery for the next near-term resistance to come in first step at 2,407 level, which is close to the psychological level of 2,400 level. An hourly close below 2,307, okay, will totally invalidate this recovery scenario. We'll see the extension of this corrective decline to expose the next support area at 2,280, 2,260, which is the key medium-term pivotal support level. Why? Because if you look at the daily time frame, it corresponds to this gray ascending trend line support level that I drew from the low of 14th of February this year. Okay. All right, so that's for the key levels to watch on spot gold XAU/USD with the key pivotal support at 2,307. But in order to see a recovery, potential recovery in short term, it got to have a clear break, an hourly close above 2,355, okay, to expose 2,407. West Texas oil continue to remain weak. All right, so it's still straight. It didn't actually break below that 79.25 short-term pivotal resistance that we highlighted yesterday. Rebound and did that bearish reaction of that 79.25 short-term pivotal resistance that we highlighted. So for sure, this is indeed a key short-term resistance level to watch to maintain this short-term bearish bias on West Texas oil. A breakdown below 77.20 exposes the next near-term support at 75.50. All right, only an hourly close above 79.25 will negate this bearish bias to see a potential rebound in short term to retest the 200-day moving average acting as a resistance at 80.50. Above it exposes 81.70, which is also confluence with the 50-day moving average acting as a resistance as well. Okay, so that's pretty much sum up for today's daily dose of insights from a technical analysis perspective. So before we go, let's take a quick look at the calendar. What are the key data to look out for today? All right, so for today, we will have UK retail sales that is out at 2 p.m. Singapore time. All right, then thereafter, we do have okay, so we have a couple of one US Federal Reserve official speaking, Fed Waller at 9:35 p.m. Singapore time. We do have the US Michigan Consumer Sentiment final reading. This result likely may not be so important. Why? Because the preliminary reading was released 2 weeks ago, and thereafter will be a rather quiet US session. Okay, next. All right, so with that pretty much sum up for today's daily dose of market insights. So I do wish you all a great day ahead and do have a restful weekend, and we shall speak again on next Monday. Kelvin, this is Kelvin here, signing off.